There's a price showing up on your screen when you check silver, and then there's the price people are actually paying to get their hands on physical metal right now. And those two numbers are not the same. In fact, the gap between them is widening in ways that should make anyone paying attention stop and ask what's really going on here. We're talking about premiums in certain parts of the world that are running roughly $20 per ounce above the benchmark most people trust. That's not a shipping fee. That's not a dealer being greedy. That's a signal that something in the physical market is under serious stress, while the paper market pretends everything is business as usual. If you're someone who wants to understand what's actually happening in precious metals without the hype and without the nonsense, go ahead and hit that subscribe button right now. It takes 2 seconds, and it helps this channel continue bringing you content that focuses on real analysis instead of clickbait drama. Seriously, just click it. We're building something different here at Element Axis, and your support is what makes it possible. All right, let's get into this, because what's happening right now across multiple regions is telling a story that most Western headlines are completely missing. The price you see when you pull up silver on your phone or your computer, that number everyone treats as the global truth, is not what buyers in Shanghai are paying. It's not what traders in Dubai are scrambling to pay. And it's definitely not what major bullion dealers in Singapore are quoting when you actually try to take delivery of real metal. We're looking at premiums that shouldn't exist in a properly functioning global market. Yet here we are. Now, I know some of you are thinking premiums always exist. There's always some difference between regions because of taxes, because of transport, because of dealer margins. That's normal. But what's not normal is when that premium gets fat and stays fat, when it doesn't compress back down after a few days or a couple of weeks. That's when the premium stops being just a cost of doing business and starts acting like a thermometer. It's telling you that buyers want the metal now, not later. They want certainty, not a contract. They want the actual thing in their possession, not a promise on a screen. Let's walk through what's happening in a few critical places, because this is not just one isolated event. In China, recent data from the main physical silver trading venue shows cash prices for deliverable silver running significantly above the Western benchmark. And even after you account for local taxes, VAT, currency conversion, all the usual suspects, the premium is still unusually large. But here's where it gets interesting. The futures curve in that same market has been flirting with backwardation. That means the nearby contracts are pricing higher than contracts further out in time. In simple terms, the market is saying it would rather have the metal today than wait for it next month. And that's not how a calm, well-supplied market behaves. That's how a market behaves when it's nervous about whether the metal will actually show up. Over in Dubai, traders are saying physical silver bars are hard to find. And when they do surface, they're getting bought up fast with premiums running in the mid-teens percentage-wise. Now, Dubai is not some tiny corner of the market. It's a global hub for capital. It's a place where buying tangible assets as a form of savings is deeply ingrained in the culture. So when that kind of market starts flashing scarcity signals, it's worth paying attention to. Then you have Singapore. One of the largest bullion dealers in that region put out an update recently saying that physical supply, especially silver, has been extremely difficult to source. They mentioned refineries being backlogged, mints slowing down or pausing production at certain times, and competitors either running very light on inventory or completely empty. Now, a dealer update is not a global inventory report, but it is a meaningful snapshot because dealers operate at the exact intersection where paper pricing meets real-world demand. They know when the pipeline is clogged. They know when wholesalers are delaying shipments. They know when you can't just order more because nothing is available to order. So what does all of this add up to? It adds up to a physical market that is behaving very differently than what the screen price would suggest. And the question you need to be asking yourself is why? Why are buyers across multiple regions willing to pay significantly more than the quoted benchmark just to get their hands on actual metal? The answer is pretty straightforward. Availability. They're not just buying price exposure. They're buying certainty. They're buying delivery. They're removing the variable of whether or not the metal will actually be there when they need it. Now, let me give you some broader context because this matters. According to recent annual surveys of the global silver market, total demand is running somewhere around 1.1 to 1.2 billion ounces. Industrial demand alone hit a record in the high 600 million ounce range. We're talking about electronics, electrical applications, energy infrastructure, all of it consuming silver at a pace that is outstripping what's being pulled out of the ground. And the market has been running deficits for multiple consecutive years. One recent estimate pegged the 2024 deficit at around 149 million ounces. That is not a small number. That is a genuine structural hole. And when you stack multiple deficit years back to back, it tells you that inventories and above-ground stockpiles matter a whole lot more than most people realize. Here's where silver becomes really interesting when you compare it to gold. Gold is primarily a monetary metal and an investment vehicle. Silver is both an investment metal and an industrial commodity, and that dual nature gives it torque. When the economy looks strong, silver benefits from industrial demand. When fear enters the market, silver benefits from monetary demand. If both of those things happen at the same time, silver can move violently to the upside. If neither happens, it can get absolutely crushed. So volatility is not a flaw in silver. It's a built-in feature. And if you understand that and position yourself accordingly, volatility becomes opportunity. But if you're sized too large or emotionally unprepared, that same volatility will destroy you. If you're finding value in this breakdown so far, take a second and drop a comment below. Let me know what you're tracking in the metals market right now. Are you watching physical premiums? Are you more focused on mine supply data? Are you keeping your eyes on the macro picture? I genuinely want to hear from you because it helps me understand what topics to dive into next. And if you haven't done it yet, hit that like button. It sounds small, but it actually helps the algorithm push this content to more people who need to see it. Now let's talk about something that's been making the rounds. There's been a lot of chatter about a very wealthy individual who has been quietly accumulating massive amounts of physical silver. The number being discussed is around 16 million ounces. That is an absolutely staggering amount of metal to absorb. And what's really interesting here is not just the size of the position, it's the method. This buyer is not using leverage. They're not buying paper contracts or ETF shares. They're going straight for the tangible stuff. Physical bars, coins, even large quantities of older circulated silver. Think about what that actually requires for a moment. If you're buying that much physical metal, you need secure storage, you need insurance, you need proper assaying to verify purity, you need chain of custody documentation. You need people you can trust at every step of the process. This is not a situation where you click a button on your phone and you're done. So when someone deliberately chooses that route, they are paying for one thing above all else: certainty. They are eliminating counterparty risk. They are saying, I do not just want exposure to the price of silver, I want to own the actual asset with no middleman and no promises involved. And when a buyer of that scale publicly signals they are willing to take down hundreds of millions of dollars worth of physical metal, it changes the behavior of everyone else in the market. Dealers start to tighten their offers. Wholesalers become more selective. Premiums start to climb. Not because the world has run out of silver, but because the available deliverable supply just got spoken for by someone with very deep pockets. Now, I am not here to worship billionaires. They can be right, they can be wrong, they can be early, they can be late, or they can just be bored and looking for something to do with their capital. But I do pay very close attention to what smart money does when it is seeking certainty. Because when someone with that kind of financial firepower chooses physical metal over paper exposure, they are making a statement even if they never say a single word publicly. They are saying that delivery matters. They are saying that counterparty risk is real. And they are saying that paper promises are not sufficient. Here's something most people do not think about. When large amounts of capital move into physical metal, it does not just express a market opinion. It actually changes the float. It changes the amount of available supply that can be readily accessed by other buyers. And if that kind of concentrated buying is happening at the same time that premiums are rising across multiple geographic regions, you start to get a feedback loop. Rising premiums attract attention. That attention brings in more buyers. More buying tightens the available supply even further, and tighter supply pushes premiums even higher. That is how genuine squeezes develop in markets, not the social media meme version. The actual structural version where supply and demand dynamics stop cooperating. Let us shift gears and talk about mine supply, because this is an area where people either develop patience or they get completely wiped out. A large portion of silver is produced as a byproduct of mining other metals. Lead, zinc, copper. That means even if the price of silver shoots higher, you do not automatically get a flood of new silver production unless the underlying economics of those other metals also support increased mining activity. And even if all of those conditions align, you still have to deal with permitting timelines, equipment lead times, labor availability, energy costs, and basic geology. All of those things operate on the timeline of the real world, not on the timeline of your brokerage account. Industry executives have been saying publicly in recent months that any meaningful expansion of supply typically takes years, not quarters. So if demand is putting pressure on the market today, supply cannot just magically accelerate to meet it tomorrow. There's another layer to this that often gets overlooked. In many mature mining regions around the world, the average grade of the ore being extracted has been steadily declining over the long term. What that means in practical terms is that miners have to move significantly more rock in order to extract the same amount of metal. And moving more rock requires more diesel fuel, more electricity, more labor hours, and more of everything else. So even if the price of silver increases, the cost structure of production can rise right alongside it. That is why the simple assumption that higher prices automatically lead to higher supply is not always accurate. The real-world math is far more complicated than that. And then there's the issue of energy costs. Mining and refining are extraordinarily energy-intensive processes. When energy prices are high, it makes marginal production much more difficult to justify economically. When energy prices are volatile, it makes long-term planning nearly impossible. So even if the geology is favorable and the metal is sitting there in the ground, the economic reality can still be a major obstacle. That is why when you hear estimates from industry analysts suggesting that significant new production capacity might not come online until closer to the end of this decade, you should not dismiss those projections out of hand. Building and launching a new mine is not like launching a software product. It is a multi-year process that involves enormous amounts of capital, regulatory approvals, engineering work, and risk. Now this week, something happened that connects all of these threads together in a pretty significant way. The White House made an announcement about launching a major initiative to create a strategic reserve for critical minerals. You can think of it as being conceptually similar to the Strategic Petroleum Reserve, but focused on industrial inputs instead of oil. The headline figure being discussed is around $12 billion, and it would be structured through a combination of public financing mechanisms and private sector participation. When governments start talking openly about stockpiling critical materials, they are effectively admitting two things. First, that supply chains are more fragile than the public has been led to believe, and second, that geopolitics now has very real teeth when it comes to access to key resources. They are also admitting that the just-in-time supply chain model that dominated global commerce for decades is now being replaced by a just-in-case mentality. And this matters enormously for silver, because silver shows up in a wide range of technologies that policymakers are suddenly very concerned about. Electronics, energy infrastructure, high-efficiency electrical components. Whether or not silver gets explicitly mentioned in every single policy document is almost beside the point. The broader theme is crystal clear. Secure access to key inputs, reduce dependency on potentially hostile suppliers, and build strategic buffers. Now, here's the part that should make you think. When a government becomes a buyer of a commodity, it does not behave the way an individual investor or even a hedge fund behaves. It does not wait around for a pullback or try to time the perfect entry. It buys in order to fulfill a mandate. It buys to avoid the political embarrassment of running short. It buys because the alternative is standing in front of cameras explaining why critical infrastructure projects have stalled because the necessary materials were not available. So the relevant question is not whether this announcement will move the price of silver tomorrow or next week. The relevant question is what happens when multiple countries begin adopting this same mindset simultaneously in a market that is already running structural deficits. And, by the way, there are reports circulating right now that delegations from dozens of countries, along with a significant number of industry leaders, have been in Washington recently to discuss critical mineral supply chains. That should tell you this is not some abstract policy idea being floated for political points. This is something that is actively being worked on at the highest levels of government and industry. Now, connect that development back to the physical premium situation we have been discussing. You have China paying elevated premiums. You have Dubai paying elevated premiums. You have Singapore reporting serious difficulty sourcing physical supply. You have a billionaire systematically vacuuming up massive quantities of physical metal. And now you have governments openly discussing the creation of strategic stockpiles. Those are not 5 separate unrelated stories. That is one cohesive theme being expressed through 5 different lenses. And the theme is very simple. The physical silver market is tightening while the paper market continues to operate as if nothing has changed. If you're still with me at this point, I want to ask you to do something. Share this video with someone you know who is interested in precious metals or who is trying to make sense of what is happening in commodity markets right now. This kind of analysis does not spread unless people like you actively share it. And drop a comment below with your take. Do you think these physical premiums are a legitimate leading indicator of where prices are headed? Or do you think this is just temporary noise that will fade? I'm genuinely curious to hear what you think. Now let's talk about what all of this means for you in concrete practical terms. First, you need to expect volatility. If you're looking for a smooth, steady ride, silver is absolutely not the asset for you. Silver is the kind of asset that will keep you awake at night, wondering what just happened, and then surprise you the next morning by moving in the complete opposite direction. That is simply the nature of this market. If you cannot psychologically handle those kinds of swings, you should not be involved in silver at all. Second, if your time horizon is genuinely long-term, then consolidation at elevated price levels is not automatically a bearish development. Markets very often need to pause and digest after large moves. If silver can trade sideways above key psychological levels for weeks or even months, what it is actually doing is building a platform. It is allowing weak hands who bought emotionally to exit their positions, and allowing stronger hands with longer time horizons to accumulate. That is how durable trends are built. That is how real sustained moves develop legs. Third, physical premiums are information. They are not the only information that matters, but they are absolutely information that you should be tracking. If premiums collapse across the board in every major market, that is telling you that the sense of urgency has faded. If premiums remain elevated even while the screen price is chopping sideways or pulling back, that is telling you that urgency is still present underneath the surface. So you need to be paying attention to what is happening in the actual physical market, not just what is happening on the price charts. The screen can lie to you. The physical market will eventually tell you the truth. Now there is a counterforce that we need to acknowledge, because ignoring it would be intellectually dishonest. Substitution and efficiency improvements. When the price of silver rises significantly, engineers and product designers get creative. Solar panel manufacturers have already spent years working to reduce the amount of silver required per panel, and they will continue pushing in that direction if prices remain elevated. Electronics companies can sometimes redesign components like contacts, coatings, and connectors to use less silver. In some applications, manufacturers can substitute alternative materials, or they can accept slightly reduced performance in order to hit a specific cost target. None of that means that silver demand is going to disappear. What it means is that demand growth can slow down or shift into different product categories. So I do not buy into the overly simplistic narrative that says shortage automatically equals straight line price explosion. The reality is far messier and more complex than that. The more realistic scenario looks something like this. If demand remains firm while supply remains constrained, price pressure continues to build over time. If demand weakens because of widespread substitution or because the economy falls into recession, the paper price can drop sharply even while certain pockets of the physical market remain tight. The real question that matters is which of those forces wins out first. Does supply expansion catch up? Does demand destruction take over? Or does the market go through a slow grinding process of higher prices until things eventually rebalance? And that is the game we are all watching play out in real time. Here is an important reality check. Just because physical premiums are elevated in certain regions does not mean that the Western benchmark price has to immediately jump up to match those levels. Markets can remain disconnected and irrational for far longer than you might want them to. Friction exists in the real world. Arbitrage opportunities exist in theory. But they are constrained by practical realities. You have import regulations to deal with, you have VAT and other taxes, you have financing costs, you have fabrication bottlenecks, you have settlement timelines. And in some cases, you have governments that would rather actively manage flows of capital and commodities than allow pure free market forces to operate without any interference. So if you are investing based on the assumption that something must happen by a specific date, you are setting yourself up for disappointment and you are likely to get shaken out of your position at exactly the wrong time. Instead, anchor your expectations to the idea that the system is currently under stress, and that stress tends to create repricing events over time. Patience is what wins in situations like this. One more thing worth mentioning, gold has been experiencing sustained interest from central banks and other official sector buyers over the past several years. When central banks are accumulating a monetary metal, it shifts the underlying psychology of the entire market. It signals to large institutional money that hard assets still matter in a world that is characterized by unprecedented levels of sovereign debt and ongoing currency competition. Silver tends to ride that same wave, but it does so with significantly more volatility. And if the gold to silver ratio is elevated relative to historical norms, it can create a narrative that silver is cheap compared to gold. Sometimes that narrative proves to be premature, sometimes it proves to be correct, but it is one of the key reasons why silver can move much more violently than gold when it finally does start moving. Real interest rates and the direction of the US dollar still matter as well. If the dollar strengthens sharply, precious metals typically come under pressure. If real yields rise meaningfully, metals often struggle. If real yields decline, metals generally get room to breathe and move higher. So when you see silver spike or crash in response to a major macro headline, do not act shocked or surprised. That is simply the nature of this particular beast. The real skill is not in predicting every single short-term move. The real skill is in positioning yourself in such a way that those short-term moves do not have the power to destroy your account or your psychology. Proper position sizing matters, risk management matters, emotional discipline matters. So here is what I am personally going to be watching over the next several weeks. I am watching physical premiums across multiple major markets. I am watching delivery timeframes being quoted by large bullion dealers. And I am watching whether this new government stockpile initiative gains additional funding, gets expanded in scope, or starts getting replicated by other countries. Those are the signals that actually matter, not the daily candlestick close, not the hysteria on social media, the real structural signals that will tell you whether the underlying stress in the system is building or whether it is starting to fade. Let me ask you a direct question. If you walked into a bullion dealer tomorrow and they told you that the screen price is basically irrelevant because physical supply is genuinely tight, and you're going to have to pay a substantial premium if you actually want the metal, what would you do? Would you pay that premium because you believe in the long-term thesis? Or would you walk away and decide to wait for conditions to improve? Think about your honest answer to that question, because it will tell you a lot about your actual level of conviction and about your true investment time horizon. Go ahead and drop your answer down in the comments. I want to know where your head is really at on this. At the end of the day, the person who physically holds the metal has a fundamentally different experience than the person who holds a paper promise or a derivative contract. And right now, the people who are holding the actual metal are willing to pay significant premiums to continue holding it. That is telling you something important. What you choose to do with that information is entirely up to you. But at minimum, you now know what to watch. You know where the real signals are actually coming from. And you know the difference between noise and genuine information. Thanks for sticking with me all the way through this. If you got real value out of it, subscribe to Element Access, turn on notifications so you do not miss the next one, and I will see you soon. And just as a reminder, everything discussed here is purely for educational purposes. I'm not acting as your financial advisor. I do not know anything about your personal situation. Use this information to think more clearly and critically, not to blindly follow someone else's opinion. Take care.